Welcome to the second step of 5-step trading FX. In step 1, we looked at the history of money and some currency terminology, as well as the basic workings of the currency market and its participants. We also showed that the government's behavior has a massive impact on the value of its currency. We then concluded step 1 with a number of different, potentially good trading ideas. Here in step 2, we will analyze how good these ideas actually are from a fundamental perspective. We will do this with the help of a so-called fundamental checklist. Before I introduce this list, I want to make sure you know what is meant by inflation and deflation, as these concepts will come up again and again when we are talking about currencies. Inflation and deflation appear when the demand and supply of goods in an economy are out of whack.
If the demand for goods is too low, then the economy will experience an oversupply of goods, leading to falling prices, which is called deflation. If the demand for goods is too high, then the system will not be able to cope either. The shortage of goods will mean rising prices, which is also known as inflation.
If there's too much inflation, the consequences can be disastrous. As mentioned before, this happened during the Weimar Republic in Germany in the 1920s. In 1920, a stamp cost 4 marks. 3 years later, the same stamp cost 50 billion marks. Hyperinflation meant that the German people had to carry their money in wheelbarrows to pay for basic living essentials, such as a loaf of bread. Deflation is no good for the economy either, because why should you buy a good today if that good is going to be cheaper tomorrow? A well-functioning economy needs a low level of inflation to make sure that people have an incentive to buy goods, but not too much, because they will no longer trust the system. Inflation of about 2 to 3% is generally seen as the ideal level of inflation. Maintaining inflation at the right level is obviously incredibly important for the whole of society, and it is usually the job of the central bank to make sure this happens. The central banks have certain tools for doing this, and the main one is interest rates. In setting interest rates, the central bank decides how cheap or expensive it is to borrow money. If it is cheap to borrow money, then this will help the economy. If it is expensive, it will slow the economy down.
Let's look at this in a diagram. If the economy is overheating, then the central banks will be worried about inflation. Raising interest rates to slow the economy down would be a real option under those circumstances. This will not only slow investment, because it is more expensive to fund a new business, but it will also make saving more attractive, because the interest rate you get on your money also goes up. Of course, when the economy is slowing down and there is a chance of deflation, then the central banks will very likely lower interest rates, in the hope that people will stop saving and start spending and investing again. Not only the central bank, but also the government itself has a big impact on the level of economic activity. Lower taxes and increased subsidies will very much benefit the economy. Or they can directly invest in new roads, hospitals or more police officers. That will stimulate the economy as well. But if the government runs out of money by not having enough income and interest rates have been lowered to zero without much effect, then ultimately printing money or quantitative easing will be the only option. Quantitative easing is really inflation created by the government with the help of the central bank.
Many people trade currencies without knowing much more about the countries involved than what they have read recently in the newspapers or seen on the news. As I have mentioned before, this is not a sensible long-term way to be involved in this market. You need to educate yourself as much as you can about the countries whose currencies you trade. This does not have to be hard though, if you follow the easy fundamental checklist I am going to discuss now. This will really give you a lot of information on the country and make you much more knowledgeable. Traders at the like of Goldman Sachs and JP Morgan will be on top of this information, and you can easily do the same.
For me to feel comfortable buying or selling the currency of a country, I want to investigate the following 4 areas. 1. Government. 2. Industry. 3. Consumer. 4. Country. Let's start by looking at area 1, government.
It makes sense to start by looking at the government of the country, because its actions play such a large role in the value of a currency. As we saw in step 1, we need to trust the government before we will consider investing in its currency.
There are 3 factors here that I want you to look at. Together, they should give you a very good feel for what the country's public finances look like, as well as the stability of the government itself. The first is the total amount of debt a country has outstanding. The second is the budget balance, And the third is political stability.
Let's start with the total amount of debt outstanding. The higher the level of debt a country has, the more money the government is wasting in paying interest on the debt, instead of being able to spend it on new roads and new hospitals.
People look at this debt as a percentage of the whole economy, which means that they look at government debt as a percentage of GDP, or gross domestic product. GDP is the total value of all goods and services produced by an economy in a given period, normally a year. So GDP really measures the size of the economy. A number over 100% means that the amount of debt the country has is bigger than all the goods and services it produces in a year. 100% is usually regarded as that point at which the debt has become too much for the economy to bear. It means that the country is going to have severe difficulties paying off that debt in the future. An actual failure to do so will trigger what is known as a government default.
Essentially, the higher the debt to GDP ratio, the less appealing the currency. So for every country we analyze, we must find that ratio. I will tell you later where to find this and other data, and how often it is published. The second item I want you to check out is how well the government is able to balance its finances. This is also known as the budget balance.
If a government spends exactly the same as it receives in taxes, the budget is balanced. But if a government is spending more money than it collects from taxes, this is known as a budget deficit. To finance this deficit, the government needs to borrow money. Assuming everything else stays the same, this is negative for the currency. If a government collects more money than it spends, it's running a budget surplus, which should increase the value of the currency.
The last factor to take into account when analyzing the government of a country is political stability. In principle, you only want to buy the currency of a government that runs the country well and that you trust. This is not just a big issue for exotic currencies, but can also play a big part in Europe and the US, where governments may not be in a position to make responsible long-term decisions. Of course, this is very subjective, but I want you to think about it carefully.
In my analysis, I'm using a company called Alliant Insurance. Alliant's ratings focus on financial losses arising from 7 categories of risk, such as currency inconvertibility and transfer risk, which means that you can't exchange the currency back to, for example, US dollars, strikes, war and terrorism, and legal risk. Each country is ranked on a 100-point scale, where 0 represents the highest level of risk and 100 the lowest level of risk. Another company that provides similar information is Euromoney, with a product called Country Risk Ratings.
The higher the political stability rating, the more trustworthy a country is considered to be, and the more appealing its currency.
Let me show you the results for the US. First of all, the US has a debt to GDP ratio of around 100%, which is continuing to grow. As discussed, this is a dangerously large number. There is a negative budget balance, which again is too high, but at least it seems to be stabilizing. Political stability is not bad, with a score in the mid-70s. But if you compare it with, for example, the Scandinavian countries, with numbers in the high 80s, it really is not best in class. The second area is industry. We need to know how the industrial sector is performing in the country you are looking at before you can feel comfortable enough to buy or sell its currency.
The best way to start is by finding out what the biggest industries in the country are. Does the country make internationally competitive products that attract interest and money from abroad? This will be much better than a country whose industries are past their peak and which needs lots of input from abroad. A country's currency might also be really dependent on factors that the country itself cannot control, such as the price of oil, or copper, or gold. Again, something to be aware of. Finding out what the largest industry groups are is easily done on the CIA website at cia.gov.
There are 2 economic items I want you to investigate here. The first is the industrial production number, and the second, the so-called current account.
Industrial production is a number that gives you an insight into the strength of the manufacturing sector. A strong industrial production means a stronger economy. It is usually what is called a real number, which means that it shows growth above inflation. The second item is the current account balance. I don't want to get into the exact definition here, but basically the current account will tell you how much money is coming into or going out of a country. This can be based on imports and exports, but also on items such as, for example, interest payments or investment income.
The current account is the difference between the money flowing into a country and the money flowing out of a country. If a country has a positive current account, there is a net demand for the currency, which is positive for the value of that currency. If a country has a negative current account, this will mean there is a net supply of the local currency, which will be negative for the value of that currency. Let's look again at these numbers for the US. Industrial production in the US is growing at about 4.7% above inflation, which is good. However, the current account balance shows money outflows to the tune of about 3.3% of GDP, which is not a number one likes to see. The third area is the consumer.
What is the state of the consumer? Is the consumer confident about the future and happy to spend? Or is he worried about the future?
The two items of data I think you should look at here are the level of unemployment and the change in retail sales.
The more people that are unemployed, the more the government is spending on paying for benefits and the less tax revenue it receives. Also, people who are unemployed tend to spend less money in the wider economy. High unemployment is thus bad for the level of a currency. Retail sales is basically the amount of goods and services purchased by consumers. Rising retail sales point to a strengthening economy.
Unemployment in the US is higher than we would like to see, at just above 8% of the labor force. Retail sales are increasing, which is a positive. You have to be careful with retail sales, as this is a so-called nominal number, and thus includes inflation. But US inflation is low, as we will see later, so this growth in retail sales is a positive. The last area is country.
Here we look at how is the country doing based on a number of other criteria that I think will influence the attractiveness of its currency. Part of this question has been answered already by looking at how the government, industry and the consumer are doing. But an even more informed opinion can be formed by looking at the following three items.
Official GDP data, interest rates and inflation. And this is what we will focus on right now.
Let's begin with GDP data. As you know, the GDP measures the size of the economy. A positive change in GDP means a growing economy, which usually means a growing demand for the goods and services that it produces, not only locally, but also from abroad. This leads to a rising demand and value for the currency. On the contrary, a negative GDP indicates an economic slowdown, which will mean less demand for the goods and services and thus a lower demand for the currency, which will lead it to fall. That is, of course, if everything else stays the same. The number that is published and that we look at is called the real GDP. This measures real economic growth after inflation. The second factor to look at is interest rates. Interest rate targets are set by the central bank, and in the case of the US, by the Federal Open Market Committee, also known as FOMC. The committee meets 8 times a year for exactly this purpose. After their meetings, they release a statement that you should read, because it explains their views on the economy and the possible next move in interest rates. In case of economic turbulence, they might change the target for interest rates in between meetings, but this is very rare.
In the US, the official interest rate is called the Fed funds rate. In the UK, it's called the Bank of England official bank rate. And in Europe, the ECB refinancing rate. In China, the government controls both the deposit as well as the lending rates.
High interest rates are good for the value of a currency, because the currency will earn a high return in the bank. Low interest rates are bad for the value of a currency. Again, all other things being equal. All I am saying here is that I would rather get 7% interest on my money than only 2%. Of course, it is not just about the interest rates today, but as much about the future interest rate when you look at the currency. Knowing the interest rates of a country is also necessary to find potential carry trades, as we saw in step 1. There we mentioned that people search for currencies that pay high interest rates and avoid low interest rate paying currencies. The third and final factor here is the level of inflation. Previously we saw that when there is inflation, the purchasing power of your money goes down. So excessive inflation is obviously not an incentive to own a currency. We also discussed that the level of inflation of about 2 to 3% is ideal for the economy. We also saw that deflation is not good for the economy, as it stops people spending money. However, when people want to hold on to paper money because they think they will be able to buy more goods with that money tomorrow than they can today, then that clearly means there's a value in the currency. The best indicator for inflation in an economy is the CPI, or Consumer Price Index. It measures the change in the cost of living for consumers and is a direct measure of inflation. Again, if it were above 3%, this would be a worry.
Real GDP after inflation in the US is growing at about 2%. That is quite slow. Interest rates are at rock bottom because the Fed has tried to stimulate the US economy as much as possible. Luckily, inflation remains under control, running at just a bit above 2%. Looking at these three factors doesn't make me want to go out and buy US dollars though. And this is the whole checklist together.
Even though this fundamental checklist is a great tool, there are some issues I want to flag. For example, political stability can change very quickly. What is today a country in turmoil can be a future beacon of stability. In addition, the data is not always correct, as data sources and people do make mistakes. And it is not just about the numbers as they are today, but also what they used to be and their future direction that are critical to the value of a currency.
Be aware that the way government debt is calculated is not necessarily the same for all countries, so you need to make sure you know what you are looking at. A country can have a budget deficit, which is bad for the currency, but a current account surplus, which is good for the currency. So should you buy or sell the currency? Or a country with high inflation probably has high interest rates as well, because the central bank wants to control that inflation. High inflation is bad for a currency, but high interest rates are good. So do you buy or sell the currency? Again, this is another issue that has no simple solution. Of course, I had to pick a limited amount of economic variables, but in reality there are hundreds. Sometimes they can give insights that my list cannot, but it's just not feasible to discuss all of them here. Another thing to be aware of is that retail sales and industrial production are very volatile numbers that can also have a seasonal factor. So always try and look at these numbers over time to find a trend.
The bottom line is that the DAX will hardly ever be lined up perfectly. Analyzing the economy and trading currencies on that basis will always be an art rather than a science. But you will kill many more DAX if you use the fundamental checklists we have just discussed. Most of the data for the checklist is easy to find, but the Knowledge Bank and the workbook include a list that shows where to find newly published data and its frequency. The contents of the checklist will have a huge impact on the long-term direction of a currency, which is exactly what I want you to focus on in 5-step trading FX. But in the short term, there are a lot of other factors that impact the price of a currency. For example, when Europe was in terrible trouble during the recent economic crisis, the currency remained much stronger than expected. One reason for this was that European banks were forced to sell their foreign assets and thus sell foreign currencies to buy euros. In addition, the short-term move of a currency is very much determined by the most recent economic data that is released. And then in particular, it's about the difference between the expectations for that economic number and the actual number itself. Usually, the currency will only go up if the actual economic number is stronger than expected. This is because, in a similar way to stock prices, the current price of a currency already reflects the consensus expectations of professional analysts.
For example, if analysts expect a change in GDP of plus 2%, but the actual number is plus 1.5%, then the economy did grow, but less than expected. So market participants might be disappointed and sell the currency, despite the positive economic growth. Alternatively, if the release comes out at 2.5%, then this is a good figure, as the economy grew more than expected, and the currency should rise in value. Or, if the economy was expected to contract by 1%, but the actual number is a negative GDP growth of 0.5%, then the currency might actually strengthen.
So you might well be right in thinking that the economy is weakening and that the currency will weaken long term. But on the day of the release of important economic data, nothing else is likely to be more important than the actual data versus the market expectations.
Here is an example of a typical economic calendar that you can easily find on the internet. We are currently building our own on lexvandam.com.
5-step trading FX is not about short-term trading, but the world changes all the time. And what may seem like an erratic short-term move can become a long-term trend, so you need to stay flexible. That is why, even when you are more interested in the long term, you still need to keep a close eye on the economic calendar for important upcoming economic data releases.
Let's now go through the trading ideas we discussed in step 1 and analyze them from a fundamental perspective.
The first idea was to sell the Australian dollar because the Chinese economy is slowing down. I want to start my analysis by investigating whether the Chinese economy is actually slowing down. To do this, I need to look at a few charts.
The first is the change in China's gross domestic product. GDP is still growing at 7.6% per annum. This is much slower than a few years ago and not much higher than the 15-year low. This second chart shows a slowdown in China's industrial production. It's not as bad as it was following the Lehman crisis in 2008, but again, a growth of about 9% is at the lower end of the 6-year as well as even the 15-year historical range. Chinese retail sales are also clearly showing signs of slowing down.
These three graphs confirm a slowdown, even though they are still at a high level in absolute terms. So I'm happy to continue investigating this idea. If we sell the Aussie dollar based on China slowing down, we need to find out if the Australian economy is indeed dependent on the Chinese economy. To do this, I will take a look at the CIA World Factbook on the internet. This shows that exports to China are about 27% of Australia's total exports and represents a very important relationship, particularly in terms of the demand for Australian dollars. Let's also have a look at the fundamental checklist for Australia to get a feel for the general picture for the Australian dollar.
With regards to the government, we can say that the positives are that government debt is low at 24% and political stability high. A small negative is that the government spends a little more than it collects in taxes. With regards to industry, we can say that industrial production is growing at about 3.9%, which is not bad. The current account balance is negative and getting worse, with money leaving the country. Unemployment is low. Retail sales are growing by 4.1%, but after inflation of 2.7% in real terms, they're only up by 1.4%. The country has steady positive GDP growth, reasonably low interest rates and low inflation.
So Australia does look in reasonably good shape right now from a fundamental perspective. No wonder it has outperformed the US dollar by as much as we saw in step 1. However, there are some clouds on the horizon, especially the negative current account balance. There's no reason to panic yet though, and the main reason for selling the Australian dollar will be if I believe that the Chinese economy is about to slow down a lot more than it has so far. Shorting the Australian dollar will cost me over 3% in interest though, which I need to keep in mind.
Let's have a look at the fundamental checklist for China as well. This is not meant as a way to evaluate the Chinese currency itself, which is called the renminbi and is very hard to trade, but purely to see what China's fundamentals look like. Government debt at 22% is not high, and the budget is pretty much balanced, so the government collects as much money as it spends. Political stability is not great though. Industrial production is slowing, but on an absolute level is still the envy of most of the world, as is the positive current account. The consumer is doing well, with low unemployment and high retail sales. GDP continues to grow fast and inflation is back under control.
In fact, the current fundamentals of the Chinese economy are looking pretty good, and the Chinese government has room to stimulate the economy if needed. Again, selling the Aussie dollar has to be based on the Chinese economy slowing a lot more than expected, and the fundamental checklist deteriorating in the future. One reason why that might indeed be the case is the following chart.
This is the price of iron ore in US dollars per metric ton, which is a key construction ingredient. The iron ore price is falling off a cliff right now. It has halved in price in less than a year. Demand for iron ore has clearly collapsed. This might mean that the Chinese economic numbers could deteriorate significantly in the next few quarters.
This is why, despite China and Australia currently being in a relatively healthy state, I would not want to discount this idea completely until I've had a good look at the technicals of the Aussie dollar chart in step 3. Maybe there is an attractive risk reward on the chart that will make me decide to do this trade anyway, based on the view that the slowdown really is more significant than expected. Or maybe there are other charts that will help me make up my mind. The second trading idea was to go long the Indian rupee because this could be the economy of the future. Let's start by looking at the fundamental currency checklist.
Government debt to GDP at close to 70% is quite bad. The budget balance is negative and political stability low. This does not surprise me, as India has been recently in the press for trying to increase taxes on foreign companies. Industry is not doing well with a drop in production, and the current account shows that money is leaving the country. Unemployment is also quite high, at around 10%. Retail sales seem okay at first glance, but are negative in real terms because inflation is sky high. In fact, inflation is higher than interest rates. Even though I can get an interest rate of 8%, with inflation running at 8.2%, this means that in real terms I lose 0.2% per year when I'm holding rupees. So the negative impact of high inflation beats the positive impact of high interest rates. None of the numbers are great, except for GDP growth, but that does come from a very low level, as average earnings are very low in India, as was mentioned in step 1. In this chart, you can see the US dollar versus the Indian rupee. 5 years ago, $1 was worth 40 rupees. Now it's worth 55 rupees. So the rupee has performed very badly.
The fundamental currency checklist shows that the Indian rupee is an avoid currency for now. If anything, I should possibly short the currency, but with interest rates at 8%, that would be a very expensive trade to run. Having said all this, I still don't want to end up missing a massive rally in the Indian rupee when the Indian economy does turn around, whenever that may be. So I'm going to put the Indian rupee on my watch list, and once it starts strengthening, I will do my fundamental analysis again. As with most things in life, timing is everything. In step 3, we will try and identify that level on the chart for the rupee where we should do our research again, because things might have changed. The third idea was to sell the Norwegian krone, because it is so correlated with the price of oil, a commodity of which I am negative, i.e. bearish. The CIA World Factbook confirms this correlation by showing that Norway is the 6th largest exporter of oil in the world. Oil and gas make up half the total exports from Norway and comprise 20% of the total economy, so moves in the oil price are clearly important to the Norwegian currency. To get a better feel for the future price of oil, I need to look at both the demand for and the supply of oil. The International Energy Agency estimates that demand for oil is increasing by around 1% per year, mainly due to demand from China and India. The Western world is actually starting to buy less oil because of the use of alternative energy sources, such as wind and solar power.
This chart shows the world oil demand in barrels per day from 1970 till 2013. It has been in a steady uptrend, but seems to be flattening off in the last part of this chart. On the supply side, the technology for extracting oil out of the deep waters near Brazil and Africa has improved dramatically. However, the real game changer is the new technologies that have made it possible to recover oil and gas from shale rocks. Have a look at the following chart. This chart compares crude reserves between countries. Saudi Arabia, in blue, has the biggest crude reserves. However, the red portion that appears above the US crude reserves represents the oil shale reserves that exist in the US, which equate to almost 1 trillion barrels of crude. That's really quite unbelievable. When shale gas started to come online in the US, as you see here in blue, natural gas prices collapsed, as you can see in red. And the real story is that China has even more shale reserves than the US. There is a much larger supply of energy in the world than people think. And my view is that over time, Norway will suffer because of this. Here is the fundamental currency checklist for the Norwegian krone. Government debt is slightly higher than I expected, but not yet in the danger zone. The government keeps more than it spends and can use that money to bring down that government debt. Politically, Norway is extremely stable. Industrial production growth is strong at 7.7%, and the current account shows that money is flowing into the country. So Norway is not using all of its oil revenues on the import of foreign goods. Unemployment is very low and retail sales healthy. Interest rates and inflation are low. The only worry here is the low GDP growth. Another argument to support lower oil prices is the slowdown in the Chinese economy, which we touched upon earlier, with China being such a large buyer of global crude oil. So I don't like the future price of oil, but I do like the fundamentals of the Norwegian krone. What should I do in this case? I don't want to sell the krone before more shale oil has come online,
and the fundamentals of Norway visually deteriorate. I don't want to take this idea to step 3. The lesson here is to not be afraid to abandon your initial ideas. Perhaps we can find a currency that belongs to a large oil exporting country that has a much worse fundamental currency profile. Venezuela springs to mind. But the Venezuelan bolivar is currently pegged to the US dollar. It would be a good exercise to find out if countries such as Russia or Nigeria might be better shorts instead. Nobody said this was going to be easy. The fourth trading idea was to go long the South African rand, because if quantitative easing continues, this will lead to a higher demand for gold, which would very much benefit South Africa.
The fundamental currency checklist reveals that total government debt is under control, but the budget balance remains negative. Political stability is terrible, something that was recently confirmed by yet another violent mining strike. It clearly is not a country where foreign companies are knocking on the door begging to do business. The current account is negative, meaning money is leaving the country, and unemployment is sky high. Production growth is low, and retail sales are growing at 6%, which is purely inflation. In real terms, they are standing still.
All in all, this is not a currency I would want to buy, just based on the idea of quantitative easing alone. So there is no need to take this idea to step 3. A better play on gold might be Peru, where gold is the largest export product as well and represents 20% of total exports, and as such is very important to both the economy and the currency.
The fundamental checklist for Peru shows low debt and a balanced budget. Political stability is not amazing, but better than in South Africa. Industrial production seems volatile from year to year, so that needs further research. The current account is not great, but unemployment and retail sales are decent. GDP growth is very good. Overall, not an amazing score, but I would feel much more comfortable owning Peruvian new sols than South African rand. The lesson here is to not be afraid to change your initial trading ideas. A look at the chart of the US dollar versus the Peruvian new sol shows that the new sol has been steadily strengthening over the past several years. There were 3.3 new sols to $1 3 years ago, and now there are only 2.61. I suspect that gold demand has been an important factor in this.
I definitely want to take this idea to step 3. A problem might be that not all retail brokers will have this currency as part of their offering. But that's okay, as this is only a hypothetical trade, not one that I would actually recommend. This is an educational course, and we are mainly focusing on the thought process here. On to the next trading idea. In step 1, I mentioned 4 currencies that might benefit from a flight to safety. Let's try and identify which out of the Japanese yen, US dollar, Swiss franc or Singapore dollar is the best currency to own in periods of serious distress.
Let's start with the yen. It has been very strong. In fact, it's close to a 20-year high versus the US dollar, with currently only 79 yen to $1.
The strength of the yen has really hurt the domestic economy, which was already suffering from competition from the rest of Asia and the financial stress of having to support an ever-aging population. The Bank of Japan has on several occasions tried to lower the level of the Japanese yen without much success, but this intervention remains a key risk when you consider going long the yen.
Having a look at the fundamental checklist shows a shocking amount of government debt and a government that spends a lot more than it brings in. That's currently manageable with interest rates at close to 0, but when rates go up, this could become an enormous issue. The combination of a yen that's already very strong, a Bank of Japan that would like to lower the value of the yen, and such a high level of government debt means the yen is not such a safe trade after all. If anything, I'd much rather be short. The second safety option is the Swiss franc. However, in September 2011, the Swiss National Bank established a minimum value, also called a floor, of 1.20 Swiss francs per euro, as you can see on the chart.
The reason this floor was introduced was that the Swiss franc had been rapidly appreciating in value, precisely because of a flight out of the euro to a safe Swiss franc. This rise was hurting the Swiss economy because it made Swiss products more expensive for foreigners. And that is why the Swiss government decided to artificially lower the level of the Swiss franc versus the euro. As long as this floor remains, the Swiss franc is not a safe haven trade, because it currently trades as if it were a euro. This goes to show the impact that central banks and politicians have on your currency trading. So now it looks like a choice between the Singapore dollar and the US dollar.
Let's compare the fundamental currency checklist first. One thing to realize is that 100% debt to GDP for Singapore is not a real number, as we will see in the workbook. In fact, it's very close to zero. The fundamentals of the Singapore dollar are clearly much better than for the US dollar, with superior performance for government, industry and consumer. Only in terms of inflation and retail sales growth is the US outperforming at the moment. This is the chart of the US dollar versus the Singapore dollar since 2001. The US dollar has weakened and the Singapore dollar strengthened from $1 being worth 1.8 Singapore dollars to $1 only worth 1.25 Singapore dollars. The reason I show this chart is that the last time we had this kind of flight to safety, which was in the second half of 2008 during the Lehman crisis, the US dollar was the clear winner. It rallied about 15% against the Singapore dollar.
So when the global economy turns sour, the safe haven effect of the Singapore dollar is outweighed by the capital retreat back into the US dollar. At the end of the day, the US dollar, despite its debatable fundamentals, remains the flight to safety currency of choice. But I do like the fundamentals of the Singapore dollar a lot, including the fact that it is an important gateway to China, which might be a short-term negative, but is surely a long-term positive. I possibly would want to go long this currency, given that our aim is to have a wide range of ideas in our portfolio. So for now, I will take the Singapore dollar to step 3 and keep in the back of my mind that the US dollar remains my currency of choice if I want to do a flight to safety type trade. The sixth trading idea was the Australian dollar Japanese yen carry trade. The idea is to buy the Australian dollar because it yields about 3.4% more than the yen. However, we do need to assess whether the yen will strengthen further against the Aussie dollar, because that would eat into this profit. Given the fundamental currency checklist for the yen and the Aussie dollar, as we saw earlier, I think that the Aussie dollar is a fundamentally stronger currency than the yen, so I am not too worried about this happening. However, this trade is not without risks. For example, if the economy slows down, this could mean rate cuts in Australia, which would in turn reduce our earnings from the carry. Also, the yen will outperform in the flight to safety scenario, as we discussed earlier. Despite these risks, I do want to take this trade to step 3, where I will look at the technicals, and potentially to step 5, where we can see if and how this trade fits into the portfolio. I found the last trading idea by looking at the Big Mac index, and it is to go long the Mexican peso.
This chart of the Mexican stock market shows that this market is one of the real winners over the past 10 years. The fundamental checklist does not look amazing. The budget balance and the current account are negative. Inflation is a little high, which keeps interest rates up. Political stability is lower than in a typical democracy, but much higher than South Africa, for example. So it has some pluses and some minuses, and is not a convincing long.
Maybe some lateral thinking is required here. Remember that in Mexico City it takes 48 minutes to earn a Big Mac. In Johannesburg it only takes 26 minutes. So labor costs are probably much lower in Mexico than in South Africa. Fundamentally, we have already seen that South Africa won't win any prizes either. I should really compare the checklist of Mexico with South Africa.
And 7 out of the 10 economic factors point to Mexico as a much better country to own the currency of. Interest rates are slightly higher in South Africa, so I receive less on my pesos than the amount I have to pay to borrow South African rand.
This looks like a potentially good trade. My main worry is if there's a lot of quantitative easing around the world, then gold will do well, and South Africa and the rand will benefit. So that's a risk for this trade.
Some brokers might not let you trade Mexican peso versus South African rand. In that case, you need to do 2 trades. The first, a short dollar long peso trade, and the second, a long dollar short rand trade. Again, this is a trade worth taking to step 3.
By now you should have a good idea of how to fill in a fundamental checklist to support your analysis of countries and currency trading ideas. Fundamental analysis often involves looking at other assets, such as commodities, and is never completely consistent, but neither will you be. just as I wasn't in my own analysis. Trading FX will always be an art as much as a science. At the end of the day, your personal view of the world and your own trading style will have a very large impact on your portfolio. I found mine, and I hope this course will help you find yours. Now it is time to move on to step 3 and have a look at the charts. See you soon.